The main thing was, look, the capital allocation cycle is happening now, and a large piece of it will be debt funded. That means risks and opportunities are present today. It's not a future thing anymore.
The AI boom is accelerating, and the infrastructure behind it is scaling just as fast. The hyperscalers have already outlined enormous 2026 CapEx plans to support this growth. The big question now is, how is all of this funded? Today, I'm joined by Dan Dreher of Legal & General to unpack what the financing looks like and where investors should be paying attention. Dan, welcome to the pod.
Thank you. No, it's great to join. Great to join.
So Dan, why don't we start off with you introducing yourself, your career, and what your role is at Legal & General?
Absolutely. So I joined L&G actually out of college. I joined directly to the Solutions Strategy team, where I spent about 5 years working on all things fixed income solutions. And then I had a little bit of an idea to go start a music company. So I was the co-founder of a music app with a good friend of mine. Spent about 2 years doing that, made billions of dollars. You know the story. And then came back to really zero in on what I could do in the solution space with a more focused mandate on all things active fixed income. So that covers both public and private markets.
For those that don't know, Legal & General Asset Management, who are you, what do you do, and who are your clients?
Absolutely. So L&G is an institutional asset manager managing close to about $2 trillion globally and about 260 billion here in the US. It is a solutions-driven firm, so we specialize in fixed income, both public and private, equity solutions, and then have a very large custom overlay business, which tends to lean towards the liability-driven investment landscape. We manage money for the world's largest pensions, both public and corporate. And then we also manage money for insurers, for not-for-profits, and for healthcare organizations.
And how did your role evolve to include thematic research such as the intersection of AI, investment, and capital markets?
Totally. So our solutions team sits between portfolio managers and external relationships. So external AUM, so think clients, consultants, and new prospects. We sit in the middle of them as the technical experts. So we ultimately partner with client and distribution teams internally to solve our clients' biggest problems. Sometimes that work is highly custom. It's tailored to a specific client or a specific consultant. And then other times it takes a, kind of a much more broad brush approach where we may analyze market trends and then, help our universe peel back just another layer of that investment onion. So thought pieces, blogs, that can really help generate really helpful conversations and, allow us to unveil additional challenges that that clients may need us to solve. So I've written on more high level stuff like American exceptionalism coming into 2025. That was out of style for a bit, but maybe it's coming back a little bit. Or something like, delineating private credit between the investment grade private credit space and the direct lending space. But then also sometimes we'll go more granular into, more granular levels of detail, like say, why is a, custom TRS basket of credit names better than broad CDS, or potentially saying like, hey, here's a deep dive into different covenant features that come alongside an investment grade private credit issuance or purchase. In the current moment, our firm's capability set really sits right at the crossroads of corporates and ABS, and then on the public side, and then on the private side, infrastructure, ABF. So really directly in the hyperscaler AI issuance pocket. So, as the fixed income lead on the solution side of things, this became, increasingly apparent that this trend would ultimately drive most capital market conversations. And, we naturally care about, who's borrowing, who's investing, whether that investment generates durable cash flow. So AI right now is driving really one of the largest CapEx waves in decades, and this directly impacts credit spreads. It directly impacts leverage, duration, sector fundamentals. So really kind of right in the square of what clients are most concerned about.
And if we tap into a few of those themes there's public debt, there's private debt, and then there's AI. So if we look at the AI investment cycle, what broad themes at a macro level would you say you're seeing?
Totally. So I think the first one is, the headline is the capital flow, right? It's this enormous AI CapEx that's entering the market. And I think the main story is it began as these hyperscalers have a bunch of free cash flow, maybe a free option, it shouldn't add much leverage to the system. And as the AI ebullience increased, the CapEx increased alongside it and pushed these companies to say, hey, we actually are going to start issuing debt to fund this. And, I think one simple illustration looks at, that I recently put together, that you look at the announced CapEx and thus the implied issuance into the various debt markets. And just taking a sliver of that, applying it to the corporate markets, you see a dramatic shift in the concentration of broad-based credit benchmarks. So think about, these hyperscalers, most of them are not near the top 10. Oracle was kind of close. But, fast forward to 2028, you see all of these hyperscalers in the top 10 to 15 and puts them right alongside banks and really shifts the investment landscape, into a much higher concentration of just a couple of companies. The second one is regulation, right? Regulation is a huge one when you talk about AI. As a firm, we talk about, prepare, don't predict. It's a tough administration to predict right now. But I would also point to the capital expenditure that's been realized to kind of say that, hey, I don't know if the market is that afraid of regulation. And I think they're approaching it from an active viewpoint, right? You saw the Super Bowl ads, right? OpenAI is running, very, very heartfelt, very thoughtful ads. You see Anthropic coming at them for, incorporating advertisement, so that there is kind of this social push behind what these hyperscalers are trying to do and what the broader AI environment is trying to do. So I think sentiment, whether positive or negative, will ultimately drive that path of regulation. So plenty more to be seen there. The third theme in this, again, all of these get talked about a lot, but I think the labor market is one very interesting one. I think most institutions, they agree that AI is structurally important. They agree that capital investment is validating that view and that the broad impact will be gradual. There will be an impact, but it will be gradual and it'll be uneven. Where a lot of the disagreement exists is the timing, right? You read one tweet and, Gen AI is real tomorrow, and then you read another one and it's 10 years away. The speed and the acceleration of labor displacement. What are companies doing? Are they firing and replacing with AI? It doesn't really seem like they're doing that. It seems like maybe they're slowing their hiring and letting their employees be more efficient. But then, probably one of the biggest ones is whether or not valuations are, properly reflecting the return on investment. So, there's nuance everywhere. Take an infrastructure project, it brings a ton of jobs to the region. It's great. They're high paying jobs. Job takes 5 to 7 years. However, once they're completed, you only need a fraction of those individuals to actually operate those massive data centers. They build it so well, there actually isn't a need for many employees. So there's a lot of nuance in the space. There's those broad-based themes that I think everyone is watching, and the speed of which it's unrolling, I think is one of the primary questions in the market.
And then a two-part follow-up to that. As you mentioned, the scale of this CapEx is enormous. I think 500, 600 billion this year. Amazon was 200 billion itself. Are we still early in this phase? And then second, what does it actually mean for investors in investment this size?
Totally. So, I mean, I like to think of it as like, so the Moore's law, computing doubles every, 18 to 24 months. So there's this exponential improvement in the capability of AI. That drives enormous demand. Companies go, hey, I can use that. Individuals go, hey, I can use that. Governments say, oh, we can make things more efficient. But the infrastructure itself does not exponentially grow. So you're going to have this CapEx pumping into it to try to accelerate that as much as you can. But ultimately, this is going to be a long cycle. This is going to be a long process because there's that much demand for it and the supply needs to catch up to the demand. So for investors, I think it really is it's a much longer running capital allocation cycle across debt markets than it is one short, kind of punchy trend for a year or two. At a base level, investors may see a potential for a massive supply shock that push spreads wider, right? Just simply way more supply than demand can meet. But then you also see the potential for major productivity gains in corporations that continue to print double-digit earnings growth. So maybe the good gets better. So I think you're going to see winners and losers. You'll probably see, continued volatility across asset classes as that perceived winner-loser dynamic changes. We would naturally push for active management, right? You need the ability to move quickly. You need to be able to get comfortable with changing your mind. But at the same time, you need to be engaged in the details underneath the hood of the AI trade. The scale of CapEx brings a sense of anxiety and fear. Thus, you get quick reactions to headlines. Take the DeepSeek moment or even Michael Burry's, useful life comments. Both led to meaningful sell-offs and then kind of traded back. And then as, people understood more under the hood, those worries were abated and it was maybe we're just back to the ROI question. Then you have Claude which, OpenAI just bought, now called OpenClaw, and that's sending a shockwave through software companies. Are all software companies dead? Probably not. Salesforce has done a phenomenal job of acquiring businesses and improving their broad structure. So I think there's a lot to be seen there. But I do think we're early, and I think the AI CapEx estimates tell that story. They're higher each of the next few years, and they only seem to increase with time. But at the same time, if those are increasing at 30, 40% per year, the Gen AI revenue has increased at an even faster rate, right? At the end of 2025, you saw, kind of 44 billion in generative AI revenue. 2026, the estimate is 168. And if if you assume the revenue climbs at that steady rate, you're very quickly outpacing the CapEx. So I think there's still a lot to be seen, but it does seem that at least for the next couple years, there's meaningful CapEx coming, and you'll continue to see this trade evolve.
So you brought up a very good point there. AI is moving really quickly. So when it comes to an asset allocator, how should they think about long-term thematic investing, given the pace of AI adoption, AI adaption, and evolution?
Totally. I think you can be very bullish on the AI trade and still misallocate, right? So what are you buying? What risks are those positions exposed to? A good example is data centers. There's inference and then there's training. Training is way more about short-term demand. You've got kind of a longer tail risk tied to obsolescence. Question then becomes, can operators keep this data center relevant as things get more efficient? Was the initial build too expensive? Then on the inference side of things, that's more of an inference type data center is more tied to the longer tail use of or the longer tail usage and adoption. So, maybe a bigger bet on the broader adoption of AI, which that also makes you more exposed to regulatory risk. If all of a sudden you're not allowed to use AI in the same way, that inference data center will dramatically fall in demand. I also think investors need to think outside of AI names and look at other capital flows towards asset classes that, are seeing more demand. So think power generation and grids, you think utilities, think regulated infrastructure, real assets, land, transmission, cooling, maybe even a business like Walmart who could dramatically benefit from even small shifts in profit margins tied to productivity. So I think the actual implementation of the trade is very important here, especially as you're entering a world where spreads are already very tight. And, you could see a dynamic where investors start reaching for yield and covenants fall off of certain structures, and the ebullience behind AI gets clouded by, maybe some structural things that you maybe overlooked.
Now, these hyperscalers have been absolute profit machines for the last few years, generating tons of free cash flow. In your recent article, Financing the AI Future, you discuss the financing gap and why traditional CapEx has now eclipsed free cash flow. So what was the core insights and takeaways from that piece that you want to convey?
Yeah, writing that, the main thing was, look, the capital allocation cycle is happening now, and a large piece of it will be debt funded. That means risks and opportunities are present today. It's not a future thing anymore. Even at the advent of writing that piece, it really was meant to be, hey, what's going on in 2026? And then big issuance hit both public and private markets in Q4 of 2025. And it was clear the race had begun, right? You saw $121 billion of issuance in public debt. That's 4 times the prior 5-year average of 28 billion. And most of it came in Q4 of 2025. You saw Meta, you saw Alphabet, Oracle, Amazon, really, really hitting the ground running. And then 2026 started hot as well. We've seen about 70 billion so far. You've seen Amazon come, you've seen Oracle, you've seen Alphabet. So ultimately, private credit is in the center of this. It's clear that the AI future would be debt funded. It's clear that they're past the free cash flow component. The private credit is not necessarily in the middle of it because balance sheets are weak and they need the riskier financing. Part of it is because the opportunity set is too large and too specialized for traditional markets alone. You need that unique lender of private credit origins to really align incentives the best way to ultimately deliver on these massive, massive projects.
You highlight the role of private credit and other debt channels in supporting the AI infrastructure build out. How do you see this evolving over the next few years?
So simply put, I think public corporate bonds they're great for the broad-based funding of large-scale operators. Maybe it's not, maybe what they're looking to do or expand in that issuance isn't too complex. Private credit, this is where, kind of its more unique form comes in. This offers flexible, fast, customized access for this construction phase. Securitized credit then might come in and, that's typically used post build out and post construction where, great assets are able to be refinanced in better, more efficient ways. So early on, we definitely see private credit doing the heavy lifting in this early phase. They can move quickly, tailor structures. They can absorb the complexity that public markets may struggle with. And this is where, private markets and public markets will likely work together rather than compete. Private credit will often finance these projects early. Again, they can get them off the ground quicker. There's less complexity. They can work with just a few lenders and, really nail that story and really find people who understand the longer term trade. And then as those assets become more predictable, we can expect refinancing them into investment grade bonds or more structured public debt. So in that sense, private credit is, acting as a bridge between, kind of development risk and then, fully institutionalized capital. And how does this affect pricing and premium, kind of this two-tiered dynamic? I think it totally depends. If you look at Meta's Meta's project down in Louisiana, about a $30 billion issuance came as a 144A security, and it was initially offered at spreads much wider than their current corporate spreads. They did this off balance sheet, which gave them more flexibility. They were able to work with just a few lenders and, and set terms that were favorable to them. But, they also offered it at a meaningful spread. This gave them the ability to execute this away from their traditional business and, kind of protect their core business. But once it was issued, spreads tightened meaningfully, right? This said that, secondary market investors saw the opportunity for Meta AA risk at much wider spreads than they're used to seeing. So they're going to buy that. So it really depends on the project. It depends on the issuer. But in that case, I think, it allowed for, kind of that mutually beneficial relationship of Meta, being able to do a large project within their comfort zone, and then investors saying, hey, that actually, we actually love that. We'll take that extra spread. We think we're getting paid for that additional risk.
And AI definitely provides, therefore, a huge opportunity for investors to benefit from investing alongside of it. Yet it also comes with certain concerns, valuation, but also risk with some of the structures that the debt's been leveraged with. So how should investors think about and respond to the AI opportunities and risks that come alongside with it?
Absolutely. I think, a lot of our clients right now are really asking the more general question of, are we seeing opportunities and are we conscious of risks? And I really think those are the right questions today. I think this is all evolving so quickly that having one hard thesis one way or another it doesn't lend itself to the dynamics of what capital markets really are. So, good or bad, time will tell. I think we're still learning about who the biggest beneficiaries are, who's going to be vulnerable. And then, I think some of this can be idiosyncratic. You're going to see some businesses positioned very well to benefit from the wave, yet they can't operationally make the transition. Then you'll see others that are in, likely highly vulnerable states, yet they're able to transform alongside the technology. So, long cycle, active trading, we're always gonna recommend for that. And thinking about it, Oracle 6 months ago, it was kind of the ugly duckling of the hyperscalers, right? It was the one that wasn't AA rated. It was the one that doesn't have a ton of free CapEx to work with. If they're doing this, they're doing it in debt markets. So 6 months ago it wasn't that great, but fast forward, the bonds had widened out quite a bit. They end up coming to market with much less debt than people had expected, and all of a sudden, on a relative value basis, that's pretty attractive. Now, are you going to hold it for the next 10, 15 years remains to be seen, but having the active management behind this allows for you to take advantage of those mispriced opportunities. And on the public side, you can really trade in and out of it.
If you're enjoying the Fund AI pod, the best way to support the show is simple. Hit subscribe. It really helps a new channel like this grow, and it allows us to attract even more interesting guests from across the funds industry. Head to www.thefundaipod.com to catch past episodes, nominate future guests, or explore ways that we can work together, whether that's consulting, sponsorship, speaking, or collaboration. Now back to the episode. If a fixed income manager or fund is thinking about positioning around these trends, what structural themes should they consider?
Yeah, totally. And I'm going to mention equities real quick. Not my world, but I saw a stat recently that the NASDAQ over the last 3 months had 56 companies outperform and 56 up and 55 down. So you're really seeing that bifurcation starting now. And I think that's why it's important to add a layer of nuance and pick what you like within this trade, right? So in fixed income on the private side, we really like infrastructure, and we really like data centers. But we like data centers that are tied to very strong operators with meaningful equity sponsorship. What that allows you to do is pre-fund equipment that ultimately mitigates the supply chain constraints. There's a ton of demand here. So getting first in line will dramatically shape the outcome. Access to power is another one, right? Do they have existing power supplier relationships, or is that is that a future risk that you have to consider? Significant land bank, right, for future build outs. Long track record of building on time and on budget. These are some of those things that can fall out as you maybe chase yield or chase an opportunity just to get a data center in your portfolio. Another thing people might look is uptimes, right? Is this an operator with traditionally high uptimes, or are you going to be paying for power and paying for space that isn't actually isn't actually operating and being used correctly? Another one, strong long-term leases. Is there, do they have relationships with the top hyperscalers, or is this a data center that is kind of, the leasing situation is unknown? Majority of operation expenses that are passed through the tenant. That's another feature of what we look for in private debt on the infrastructure side. And then one other thing, and we kind of touched on it a little bit with the regulation stuff, but community involvement is very important. Having support of the community and not allowing some of that local legislation to slow down the ultimate product and build out. On the ABF side of things, we see a lot of value in co-location data centers, so they're coming at much more spread than wholesale. The trade-off there is long-term leases versus multi-tenants on shorter leases. This is more of a public view, so there's more liquidity, there's more ability to trade in and out of it. So right now, the fundamentals for co-location centers look really strong there. There's a ton of there's a ton of demand, and you're getting paid for it. You're getting paid for it substantially. The third thing I'd mention is to just be cognizant of software exposure. We tend to think that software exposure, where there is a very large total addressable market, is the more vulnerable stuff. More obvious for models to attack, more obvious for models to steer their focus there, and ultimately, to trade that away. Notably, equities are the ones getting whacked right now. But, everywhere with software exposure is seeing some weakness. So take CLOs. Roughly 15% of the leveraged loan market has software exposure, and the distress levels are ticking up there. But software exposure is very different in CLOs than it is in equities, right? Up in the stack, CLOs benefit from structural subordination. AAA CLOs down to single A CLOs have not had an impairment since 2010. CLOs can also carry much stricter diversification limits. And importantly, a lot of CLOs are actively managed. So that gives managers a chance to rotate out of vulnerable exposures. There's a lot of software exposure in the market. It's just important to be aware of the extent of it, and then be aware of, kind of the more individual structural decisions that can be made with how you implement and maintain that exposure.
And on the software side, it is interesting. As of February 2026, we've seen a lot of SaaS companies take a beating in the equity markets because of the potential risk that they're seeing from AI there.
Totally.
So we've walked through then some opportunities, and we've touched on potentially some of the risks that could be associated with the AI build out and the investment there. So if we were to go full circle there and say, how should a risk-adjusted investor then think about the leverage financing conditions and the structural risks associated with all this AI CapEx?
I think risk-adjusted investors should really focus on leverage, liquidity, and structure altogether, not in isolation. The more AI CapEx that is funded through asset level and project level structures rather than corporate balance sheet should help kind of contain the systemic risk and keep leverage down. But again, need to focus on, on where that leverage is coming from. Liquidity considerations are a big one, right? If you feel that, you're looking for exposure to this and you're looking for lower leverage, that's great. Maybe some of these, more private asset level, project level type structures fit. However, you need to recognize that will come with less liquidity, right? Private credit offers the structural protection and flexibility early on, but public credit markets are really where there's that critical source of liquidity, and then some price discovery for that matter, right? I mean, mentioned Oracle before. That's one way to kind of measure how the current environment is managing the AI risks, or at least perceiving them. And then structure, again, this is where the nuance comes in. What is the risk you're investing in? Is it being offered at a high spread because it's a new structure and, people don't really know as much about it and there's kind of some complexity risk there? Or is it because it's a risky structure and there's less covenants and it looks similar to other deals because there's so much demand that it's pressing the spread tighter? I mentioned before on the private credit infrastructure side of things that we like equity-backed sponsors who can deliver those upfront payments to secure materials. There are not endless materials, and the dynamics of a deal can meaningfully weaken if enough time passes and progress on the build is ultimately delayed.
Okay, so that's a good example. You mentioned an area that you like. If we were to look at the credit market with all this debt coming down, are there certain segments or areas that have a greater opportunity or a greater risk?
I definitely think right now, and on the public side of things, where, on the private side, there's a little bit, it's more of there's not so much an issuance calendar. You don't really know the deals that are, all the deals that are happening. So the easiest, downside view is looking at public markets where, we definitely remain mindful of the growing impact of AI on the sectors that are, most susceptible to disruption. So you mentioned software, brokers as well. They're seeing some weakness. Fintech is seeing some weakness. But then we're also evaluating other services-oriented industries that could be vulnerable to this disintermediation. So managed care, pharmacy benefit managers, advertising. There's a number of those underlying risks that, that might fall outside of what is traditionally thought as AI, but from an actual operation standpoint, there could be some more vulnerabilities there.
Very interesting. Now, you've offloaded a huge amount of insights and knowledge in this episode so far. So if you were to wrap up with one takeaway message for the audience, what would that be?
Underwriting matters. it starts with understanding the risks that you're actually getting paid for, right? Good risk is being compensated for complexity, maybe construction complexity, asset specificity, something that is, maybe a little bit newer or harder to understand, or liquidity in well-structured deals with strong collateral and contracts. If you're willing to set it and hold it, then that's potentially a good risk to get, or a good risk to get paid for. Bad risk is reaching for yield, accepting weak structures. It's aggressive refinancing assumptions, or exposure to assets without durable cash flows, without without that long-term lease, or without known demand for a given entity.
Now, just wrapping up on a personal level, is there a book that you would recommend that has had a profound impact on how you think about investing, technology, or market structure?
Totally. I think I'll probably address this kind of sideways by mentioning a book I've read, read a number of years ago, but The Tipping Point by Malcolm Gladwell. There, the core idea is that big changes don't happen gradually. They happen when the surrounding environment becomes ready for that change. My dad is actually a patent attorney, and he's been reviewing AI related filings for years, long before ChatGPT, long before any LLM. So from his perspective, AI didn't suddenly emerge in 2023. It's been around. It's been, the technical groundwork has been increasing and building up for a very long time. So what changed wasn't necessarily model intelligence. It was more the context, right? Cloud infrastructure, very much matured. APIs became a thing, and they became pretty standard for any product. Enterprises digitized workflows. Compute costs, all of this became a lot cheaper, and data became much more centralized, either in a given corporation or just more broadly with the Googles and the Metas of the world. So the system is now more capable of absorbing AI at scale. And I think we're now seeing that second level confirmation that the context is real. Enterprise capital expenditure is driving this. It's not hype. There's true economic commitment behind it. And these companies don't historically move CapEx because something is trendy. They might talk a certain way, but typically to follow the money. That's really what they believe, and that's really what they think is going to happen. And they believe in this because it changes their productivity and it changes their competitiveness. So I think we've clearly hit the social tipping point, broad awareness, broad usage, but the enterprise spending is what suggests we may be crossing that economic tipping point. And for investors, that's the difference between a viral product moment and something that is truly investable. So for me, the big insight isn't that AI suddenly got smart. It's that the environment and now the capital are prepared for it.
Good recommendation. I have that book in my bookcase, so highly recommend everyone check it out as well.
Oh, yeah.
Well, Dan, you've dropped a ton of insights today. It's been super insightful. I'm sure there's plenty in the audience that would love to follow along to read your insights, blogs, and articles. So how can people reach out to you, contact you? And also, if you could share for us what L&G's website is as well.
Absolutely. So LinkedIn will be the cleanest. Our marketing team does an awesome job. The website's also phenomenal. So there's a ton of insights outside of what I've spoken about here. And then simply Dan.Dreher at 𝒊𝒔𝒐𝒏𝒈. Please feel free to shoot me a note, and happy to hop on and discuss anything you're thinking.
Brilliant. Well, Dan, really appreciate your time today. Thanks for coming on the pod.
Iain, thank you, brother.
If your fund or firm still runs critical processes on Excel, you're not alone. But the opportunity isn't just AI. It's unlocking the Microsoft tools you already pay for, like Power BI and Power Automate, to eliminate manual work and reduce key man risk. At Zentia, we know funds, we know Microsoft, we know AI, and we move fast. Book a 1-hour sprint audit at zentia.io, and we'll identify 3 quick AI or automation wins to build immediate momentum for your firm.